Hello. Thanks everyone for joining me. I'm excited to dive into this panel looking at the fund landscape. 2018 was a very interesting year. LP lawsuits, funds were down 60%, lots of them shut down. And here we have three gentlemen who are going to walk us through what they expect for 2019, how the strategies are changing, what are the projects that funds are looking at, and how to raise money in this sort of quasi-bear market, bull market. I'll be moderating. My name is Frank Chaparro. I'm an investigative journalist and financial journalist at The Block. And I think we'll kick things off with Brooke, who's joining us from the West Coast. You're in the process of raising money right now for your fund. It's going to be a venture capital fund of funds. I think it'd be a good place to kick things off, just thinking about or exploring what raising money right now in mid-2019 looks like with Bitcoin trading at $5,000 and what that experience has been like for you.
Certainly. So it's definitely not as easy as it was when Bitcoin was at 20,000. No shocking development there. So just for context, we run a blockchain venture capital fund of funds. So we are a fund of funds investing solely in blockchain dedicated venture capital funds. So we only do closed-end funds, no liquid structures, no hedge funds, no trading stuff. So that is our focus at Hutt Capital. So we haven't had the same, I'd say, declines as you've seen on the hedge fund side. So it's both been, I'd say, more difficult, naturally as markets cycle, it's easier to raise money at the top of the market versus the bottom of the market. We've also seen LP sentiment change quite a bit where, in 2017, start of 2018, you saw a lot of money chasing hedge funds, trying to kind of make a quick buck, so to speak, on the crypto markets. And you've really seen the interest from institutional LPs evolve from that to, at least from my conversations, be much more interested in the venture side of it, much more long-term focus, realizing that you need to invest for the long term versus trying to, make a quick buck in a very, very volatile market, and they've seen that work against them now. So, we have much more exposure to, equity versus the token side of things. So I would say we're not as impacted as, we've seen some folks in the hedge fund side. We've also seen, as I mentioned, more interest in the venture strategy versus hedge funds. That's been helpful. But of course, as markets go up, it tends to bring more interest and drive more urgency.
Now, that's an interesting point. I think we've seen, even though this is a hedge fund panel, right? A lot of the interest is moving to venture. A lot of the recent big capital raises have been around venture funds. I think Pantera recently closed their $175 million fund. Alexi, is this now, in terms of the fund-to-fund market, do we just need to forget about token investments, liquid investments, hedge fund strategies, and completely jump on Brooks' bandwagon of VC investing, or is it the death of the hedge fund and crypto?
Yeah, it depends how you look at the space. So there's different ways that investors are starting to look at the space. So you're excited about the technology space, and it's kind of like the Bitcoin versus blockchain. So if you're interested in blockchain, then I would say, jump on board the VC bandwagon, as it were. But if you're interested in a bit more about the price and the kind of bottom-up trading opportunities that are there, then I think the hedge fund game is not dead. There's a lot of players coming to the market that have experience in the sector, have experience in managing money from a hedge fund point of view, looking at different opportunities. There was the exchange arbitrage game that was pretty prevalent in early 2018. It's kind of got ironed out, but there's a lot of different other strategies. There's a lending market now, so there's a lot of strategies that you can do in the hedge fund game.
And what's going on exactly at Elwood? Explain to the audience what you guys are interested in from an investing perspective.
Yeah, so at Elwood we do some proprietary trading ourselves. We have a number of different traders trading different strategies, more market neutral, directional. And then separately to that, we have a fund of funds business that is looking at hedge funds, particularly, we wanted to stay away from the VC style of investment because that's not where our expertise lies. Our expertise lies in assessing fund managers from the hedge fund side on more liquid terms, like 1 year lockup, quarterly redemptions. So that's where our experience lies from Brevin Howard's, and that's where a lot of us came from. So we understand that world a bit more.
Makes sense. How about you? What do you make of this sort of VC hedge fund chasm and divide?
So I think you have to think about, where kind of we started in this space as an asset class, right? When you back up, Bitcoin was really the only asset, so there wasn't an asset class to begin with. And I think as you saw an introduction of really largely Ethereum is kind of what catalyzed pulling a lot of people more into this and thinking of it more as an asset class. So you had a first wave of funds that largely came in as generalist investors, and they really invested and tried to do anything really to make money. They would invest in liquid tokens, they would participate in ICOs, they would do some private investments. I think what we saw through 2018 is some maturation of this asset class as an investable asset class, in that there was specialization of strategy. And so one of the things we tried to focus on at Vision Hill under our research division is what are those different strategies that people are employing, at least on the hedge and venture side. And what we came up with was, fundamental, opportunistic, quantitative, smart beta, and venture. And so when we look at the landscape, we try to segment into those 5 category classifications and say, within those specialization of strategy, how are people performing and what's their unique investment strategy and unique investment edge within each one of those categories. So from a broad standpoint, I think that's how you want to approach them.
Yeah, so 2018, late 2017 might have been defined by, I know what Bitcoin is. I'm gonna go to my mom, my cousin, my Uncle Nino, they're gonna give me some money and I'm gonna invest in, make a fund, so to speak. Now we're seeing more complex strategies. Break down for the audience what, you mentioned smart beta, you mentioned some others. What do these strategies look like and how are they going at your firm?
Sure. So I think fundamental is probably what everyone is most familiar with. This is really thinking about token value accrual at the end of the day. A lot of these are either long-only strategies or a developing long-short market. I think the reason why we haven't seen true long-short funds in this space like we have in the equity market is one reason is the borrow market, right? So it's been pretty difficult to short assets in this asset class. That's developing and has developed through 2018, so that's a particular area that we see development through 19 and into 20. Thinking about the other buckets, so the way we think about opportunistic is not the way that traditional markets would think about opportunistic. We actually put what's called generalized mining and credit in that bucket, and there's some people in the room who run those type of funds. Generalized mining is really just active network participation. It's provisioning supply side services for a particular network. In credit, think about a traditional lending business model. You're essentially buying a portfolio of loans, either from a BlockFi, a Salt, or some of the decentralized lending platforms. On the quantitative side, this is, again, pretty self-explanatory, but it's quantitative aspects of applying probably a traditional momentum driven and other strategies to this asset class in a liquid way. And then smart beta is both your passive indices that have developed, whether it's a Bitwise or other products in that way. And then venture, I think, is pretty self-explanatory. So,
what do you guys think about there's been a lot of news and headlines and hype around staking and using that as a way to, get some passive yield out of these different types of assets. From the hedge fund and fund perspective, is it as big of a deal as the headlines might suggest in terms of the impact for your businesses?
I think it's a developing market, right? I mean, the difference between proof of work and proof of stake, that debate will continue to rage probably for the rest of this year and going forward. And there's other consensus mechanisms that may compete with those. From a business standpoint, I think fundamentally what we have in the crypto landscape is you're organizing human behavior in just a fundamentally different way, right? So the token model itself is is very, very different than a capital structure equity, and it's very different than a debt, which is my background that I come from. And so in thinking about staking or put your reputation on the line of provisioning services to these networks, there will be returns that can be driven from these type of strategies. And it's really sophistication on the software side at the end of the day, which is what drives this.
Yeah, but I think for proof of stake networks, the staking, I guess the ability to stake your coins and get, let's just call it interest, maybe it's not the appropriate term, but be paid to stake your coins is a wonderful thing. And on the venture side, you should absolutely be doing that. You're holding for the long term anyways. If you can be paid to stake your coins, it's a great setup. On the venture side, typically, your allocation to the token versus equity side, it's going to be a smaller portion of your portfolio, so it's not going to move the needle in a drastic way. But I mean, you're going to hold those tokens anyways, and I know there's talk of people show, okay, well, if you compare what you make from staking versus the inflation rate, maybe the real value accrued through staking is less, but if you're holding those tokens anyways, you're already going to be undergoing, the impact from inflation. So I absolutely encourage, our managers to do that, and think it's a great thing.
So I think from the hedge fund liquid point of view, I think staking is not quite there yet in terms of an investable strategy for us, because until you get a good enough size and borrow to hedge out your price risk, then it's not a viable strategy quite yet. I think if you're looking from the venture side and you're already holding those tokens, then it makes sense to gain extra yield on your tokens. But at the moment, there's only good enough markets for borrow for maybe the top 5 assets.
I think it might be worthwhile to think about the headaches that you guys have to deal with. I'm sure there's a lot outside of just managing other folks' money. Crypto introduces a whole slew of issues from a technical perspective. You think of things like the lack of there being prime brokers in this market, the lack of marketplaces that are of high enough caliber and that are robust enough to support the type of trading that you might see on Wall Street. For the folks who are managing liquid funds and are doing trading, what does that look like, and where do you see improvements happening right now in the market, and what do you expect for 2019?
Yeah, so I think that prime brokerage is a big thing. It's the same side of the coin as custody. So I think you need in the traditional market, someone to sit in between yourself and the exchange and manage your exposures on between exchange and the other exchanges. So a large amount of revenue from trading comes from moving between exchanges quite quickly, and it's not an efficient use of balance sheet to be having all your capital on one exchange and then moving it to another. So prime brokerage is going to be a big thing. I think that there's interesting developments from Fidelity and what they're doing, so it's really quite interesting on that front.
Yeah, I would add to that point. I think we're starting to see integrated custody, settlement, and trading, right? And those 3 things integrated, really, really important for that layer. To Frank's question about liquid markets, I think the report that Bitwise Investments released publicly as a response to the SEC on their ETF was really revealing. People often ask about market integrity and liquidity. I think that report highlighted that there's really only 10 exchanges out there among the hundreds that should really be trusted as far as true volume goes. And on-chain FX, a division of Masari, has sort of adopted that, real 10 volume metric now that you can see. I think that's really important for 2 reasons. One is it doesn't show artificial trading. It doesn't let wash trading determine volumes of tokens that probably don't ever trade or don't really have value in the market. And it also makes data integrity really important. So anyone, for a quantitative strategy especially, your data integrity is your end all be all, really, right? So something like that report and getting to market integrity is really, really important from the liquid side.
The fact that, what's the old saying? The 3 types of lies, damn lies, and data. Maybe market data is the 3rd damn lie. How do you operate in a market where Jesus, I mean, 95% of the volumes are fake. How do you engage with that? How do you know you're not, getting front run by one of these exchanges, or, you're going to go make a trade and it's going to come against you because it's just really exchanges moving coins between their own wallets? How do you interact with that?
I would argue you just made a great argument for active management versus passive management, right?
Well, tell us, how's that so?
Well, again, like if that's all you do, if you're an active manager and you're focused on liquid trading strategies, you're going to first pick your counterparties that you want to trade with, who are not front running you, who the data is, there is data integrity there, and you're only trading with those counterparties that you trust. If you're a retail investor or you're out there trying to do this on your own, you're going to run into those types of issues and many other issues, right?
Do you think in 2018, 2017, the active managers outpaced the market on the whole? I mean, we saw a lot of these guys just completely get wiped out. What separated the wheat from the chaff?
So we put out benchmarking work in the space, just to highlight this and the interest of transparency. So in those 5 category classifications I spoke about, we put out quartile performance anonymously of all the funds that we collect performance on. That's, again, really, really important, because comparing peer funds to each other within those categories is better than an apples to orange comparison for a quant fund to a fundamental manager. And what we've actually seen is active has outperformed passive over the time period, at least, that we started, and that was the Q2 18 through currently. I would expect to see that continue, especially as the early hedge fund structures that were hybrid, that were investing both in public and private crypto markets, as some of those private investments start materializing and monetizing, you're probably going to see outperformance from those funds instead of that trading like a cash asset on their balance sheet.
Brooke, how do you set the expectation that, because 2018 saw a lot of LP lawsuits, people pissed off and they're down 60-70%. Some funds might not have set the expectation in terms of, all right, we're going to beat Bitcoin. This is what we're benchmarking against. Or maybe we're going to beat these top 10 assets. How do you, as you sort of try to get this fund off the ground, set the expectation and say, all right, here's what our mandate is in terms of delivering alpha for you?
Yeah, so the way we think about it is, if you think about the venture side of the market, you're investing primarily in equity. So these are companies, to the earlier points around the infrastructure and the data, these are the companies building that infrastructure. Companies like Masari and Coinmetrics building out, the data providers in this space, which are going to make it a more institutional market. Areas like, tokenization, the digitalization of assets, a lot of non-crypto use cases of blockchain technology. So, I don't think about our benchmark being Bitcoin or the crypto markets. Our focus is on building large, sustainable operating companies that have revenue and profits and products versus trying to beat the crypto markets. So, to be honest, while it's certainly to our benefit if crypto markets go up, and if you're investing in crypto infrastructure, clearly you rely on the health of that market. We want to perform well no matter, Bitcoin's up 100% or down 50%. We want to be effectively as agnostic to that as possible. We don't care which tokens do well, which ones don't. And it's very long-term focused. So in 2018, crypto markets are down 70, 80%. The venture funds actually were positive in 2018. So, why is that? It's because they're building real businesses, they're adding customers, they're growing revenue. They're not speculating on crypto pricing. So it's a very fundamentally different model. So we think about it more absolute long-term returns versus, comparing it versus crypto benchmarks.
How do you set the expectation for LPs?
Yeah, it's kind of funny. In 2017, a lot of funds were like, we're absolute return funds, whereas 2018, they're now saying, oh, we're like mutual funds, we've outperformed Bitcoin. We're only down 60% on average, whereas Bitcoin's down 8%. So can't have it both ways. I think that if you're a quantitative fund, then the expectation is that you might not outperform Bitcoin in a bull market, but you will definitely outperform it in a bear market. And I think if you're a more fundamental one, then your expectation is that you'll outperform in a bull market, but you're drawdowns will be similar to the market. So really, when you look at this, I think the expectation is that you need to create like a diversified portfolio across these strategies. And that's the only real way that you can get better risk-adjusted returns in comparison to the market.
All right, here's a question for all three of you. What is keeping you guys up at night? What are you guys worried about in terms of investing in this market?
So I think that custody is keeping your Bitcoin assets or crypto assets in cold storage is one thing, but there's another side to that is in thinking from a more liquid strategies, is because a lot of these hedge funds keep assets on exchange, and it's how do you manage access to the exchange, who has access in that regard, because once assets are on exchange, for those that are familiar with trading on crypto exchanges, is you can transfer off exchange pretty easily. So we're looking at a lot of third-party providers that are trying to solve that problem and trying to encourage the more quantitative funds that have a lot of their money on exchanges to adopt those sort of providers.
Real quick, I want to focus on custody before I get to your guys' anxieties. It almost seems like every week there's a new custodian that rolls out, and still this seems like almost it was like a 2018 talking point. People still are concerned about custody. It seems like the problem has been solved. What's going on?
I don't know.
I think there's been a lot of development in 2018. I mean, I think custody is a regulatory issue at first. You need a regulated custodian. So you could either go the broker-dealer route, or you could be a regulated trust company. And some people chose one or the other. We've seen South Dakota be the banking charter of choice for some people, and then the New York FDAS be the other, which is sort of the way Coinbase has decided to go. From the funds that we invest in, I think custody is getting solved. It seems like there is probably a handful of choices. I won't mention all of them, but there's a handful of choices you can go to for third-party custody that have different trade-offs between abstracting away ownership of your private key or non-ownership of your private key. That's a choice for you as an individual or a fund. I would say that's getting solved. What I'm looking forward to is integrating that custody, settlement, and trading, like I said, right? Because that enables liquid strategies to really kind of take it to the next level and add borrow to that, and then now you really got something powerful.
Yeah, if I can add to that, I don't think the issue so much is that there aren't good custody solutions. I mean, it's one, they have not been around for very long, so there's no one out there who can say, oh yeah, we've been custodying crypto assets for 10 years, we've had no issues. I mean, it's just such a nascent market. A lot of the more institutional solutions are relatively new from that perspective, and a lot of institutions are used to custodying their traditional assets with BNY Mellon and State Street.
Yeah, exactly. Let's be honest, South Dakota is not really the financial mecca of the plains. Is that a charter that you can trust?
Well, I mean, I think you have to look at any individual company solution to decide whether you trust them or not. But I do think there are plenty of trustworthy custody solutions out there, and the hedge funds use them, right? They trust them, and they've never had any issues. I mean, I should say the good hedge funds. But still the idea of if you don't own your key, if you don't have your key, you don't own your crypto, is just a very powerful hurdle to get over initially, and eventually people will get over that, and we'll see broader adoption. I think it's more of a mental thing than a technological issue at this point.
Makes sense. Well, since this isn't a custody panel, let's go back to the anxieties that you guys are thinking about for 2019.
Yeah, I guess I'll go next inside the mic. So for me, the thing that most keeps me up at night as I'm thinking about building our fund is, so we only invest in closed-end venture capital funds. So we do not invest in any liquid crypto funds, and what that means is, you see a fund come along like Paradigm, for example. So folks who are not familiar, one of the co-founders came from Sequoia Capital. One of the co-founders was one of the co-founders of Coinbase. So amazing team, raised a bunch of money. I would love to have exposure to the venture portion of their portfolio, but it's only about a quarter of their fund. They're structured as a hedge fund with very long lockups. What that means is they're capped in terms of how much they can side pocket in liquid investments. So, what I worry is, okay, what if you see more people do that like super long lockup hedge fund thing, and you might miss out on deal flow on the venture side that those guys are winning and we don't have exposure to it. So, I still feel very strongly about the closed-end venture model. We, as big of a fan of those guys as I am, we're not investors in Paradigm, nor would we be structurally, because I think the liquid side of it is too big a part of the portfolio. But that's something I think a ton about, and I really wonder how that's going to develop. And I just think it's very important that we maintain a flexible mindset and watch how the market develops.
I think adding to Brooke's point, what keeps me up at night is making sure that we can deliver to our investors, the best return possible for what they're really asking for and for what we have delivered as a product, right? And so one of the big feedback items that we've received lately being on the road is that the same way hedge funds started to specialize in strategy, we're starting to hear the market, if you listen, like asking for specialization of products. And that's both bespoke, like these are the things I'm interested in and that I want, and that's where I want to drive my return. And it's also on a duration landscape. And so I will probably sell Brooke's product a bit here, but people are asking for shorter duration products that are simply alpha delivering and that don't have any market beta. The middle area is where you can get sort of liquid strategies and get your medium-term beta on a weighted average investment period. And then you have the longer duration stuff, which is probably more suited to venture. And I think the reason why existing investors are sort of asking for the former and the latter right now is because you have a 2018 environment where you draw down on the liquid side 85 to 90%. That's a scary proposition. Not only am I entering a new asset class, but now I have to enter something that can potentially draw me down 85%. So I'm going to naturally be a bit more defensive and go back to things that I know, right? I understand non-market neutral strategies. I understand venture strategies. And I think that's why we've seen more capital enter those strategies recently, especially on the pension side and true institutional capital side. I think it's easier for a family office, and I know this crowd is more family office geared. You just have more control over your investment, less parameters to deal with, right? And so it creates more flexibility.
It makes me think of something that I've been picking up on in the market. So much money is going towards VC. I think Paradigm's $400 million that they've raised. I mentioned Pantera before, $175 million. Not sure how much you guys are trying to raise, but I'm sure it's money. Is there an issue where we have almost a second bubble brewing in the venture market where too much money is going after too few projects? Like I have an embargo in my inbox for tomorrow morning, a $15 million fundraise for a company I never heard of. And the question here is, you need, or not you specifically, but your funds that you're investing in, they need to find, they have all this money sitting on their table, they've got to put it to somewhere. Is that an issue for the market?
So I'd say as it stands now, no. So this is a very nascent market. There is not the breadth of opportunities to invest in venture, make venture capital investments in equity within the blockchain space versus, let's say software, for example, where it's been around forever. There's, hundreds, thousands of companies being raised. But the offset of that is that there's just not nearly as much capital chasing the opportunities. So, I did some research recently, and there are 50 venture funds that have raised or are currently targeting, so these are dedicated blockchain venture funds, $3.8 billion. NEA by itself, one of the largest venture funds in the world, is targeting $3.6 billion for that one fund. So there's just not nearly as much capital chasing it. So no, I mean, to be honest, that's not something I worry a whole lot about. I definitely keep my eye on it, but it's not a major concern for me.
I'd just like to add one thing to that. So again, just because these are different ways of raising capital, what you see in traditional VC is sort of a regulated seed, Series A, Series B, Series C. Everyone kind of understands the cadence of capital raising in that regard. The token model is a bit different because if you're raising a SAFT for an intended token business, or you're raising equity that perhaps will convert, or perhaps you're raising equity and tokens alongside each other, which we've seen recently, you're probably going to see larger rounds with higher valuations because there may not be a Series A or Series B next. There may be one raise here that puts capital on the balance sheet for these projects, builds out team, and then the next thing you're going to see potentially is a mainnet launch of that public token. And so there's not much in between here, right? So it's not surprising to me to actually see valuations higher in the early stage because there isn't the opportunity to say, well, if I miss this now, I'll just get it in the Series B, which a lot of people do on the traditional side.
They have to get in now because they're not never up to
Yeah, I would say typically what I've seen most is for private token sales, there tend to be multiple rounds where typically the first one is priced much better than the second one, and the second one, I absolutely agree. You've seen some honestly ridiculous valuations that have happened, and part of that is money chasing opportunities. Part of that is kind of a certain protocol is progressing well and people pour money into it. Where how many new protocols are going to exist every year? It's not a massive number. So if you're looking into that space on the token side and you want that exposure, there's only a limited number of opportunities. So you need to make sure you're involved in those, and that drives up valuation. So in that case, I do agree with that point.
I don't know where we are at on time. I know that I don't want to step over Pollack's session. Who is in charge? You can tell me if I can take a question. What do you think? You have time. All right, let's do it. Who has a question? This gentleman right here.
Good afternoon, everybody. Mike Rogers from Topic Capital. I was just curious, speaking of topic of venture capital, have you been recent Horowitz decision to restructure the RIA to get more exposure, be able to have more liquidity to invest in assets?
Yeah, so as a venture fund funds.
So he basically asked about what the panelists think about Andreessen Horowitz restructuring their firm to be a registered investment advisor. That news broke earlier, I think, this week. Yeah.
Yeah, so as a fund of funds only investing in dedicated blockchain venture funds, I have mixed emotions. I think from an Andreessen Horowitz standpoint, it's a great move. It provides a lot more flexibility in terms of what they can invest in. For me, the question is, okay, does this then mean that they no longer need a dedicated vehicle for crypto? I expect they'll continue to raise one, but if you saw more folks going that route, a lot of generalist funds have or have considered raising dedicated funds. Part of that is it's a very different strategy than what they're currently doing. A lot of their LPs don't want the crypto exposure, so by doing it through a different vehicle, it allows best of both worlds. And for me, I want as many dedicated funds as possible, right? Because in terms of the opportunity out there, and if you saw more people doing this, it might allow more generalist funds to do more in crypto and increase, the level of competition out there. I don't think that's happening anytime soon. Not many firms out there are as creative and forward-thinking and willing to change as Andreessen Horowitz, but from their perspective, I think it's a wonderful move.
Usually leaders, you expect you to have the full policy.
It's definitely possible. I just think that there's a lot of tradition in venture capital. People do not move quickly to changes despite investing in things that are changing very quickly. It's kind of ironic.
Does anyone else have any thoughts on that? Any other questions? Yes, sir.
Hi, Harry Sudar, Grid Infrastructure. I had a question about, I've heard a lot about venture capital, and I've heard a lot about liquid active. Where do you think that other vehicles like private equity or like debt funds fit into this overall investing landscape? They seem like two other buckets that we haven't heard a lot about yet.
Yeah, and Mike Novogratz had some news out of launching a massive debt fund, or distressed debt fund. Distressed debt is an opportunity probably in this market with a lot of these projects. What do you guys think about that?
I'll speak very brief on the private equity side. Venture capital, of course, is part of the private equity market, but the market just isn't mature enough to have big buyout funds chasing this stuff. There aren't massive companies that have hundreds of millions of EBITDA. Even at the growth equity level, all the growth equity guys are looking at the space and thinking about it. And some of them pour it into companies like Coinbase, but they need a more mature market in order to be investing regularly. So there's interest, but it'll come to them eventually.
Yeah, I agree. I think that it's still too early stages for distressed debt, and in terms of a scalable product as well. I think you'll probably be able to have maybe at most one big fund doing it, but it's not a scalable strategy for more funds to do it.
I think private credit is really interesting. I come from a credit background. I was at JP Morgan 11 years, traded high yield corporates and CDS, so I understand sort of the credit aspect of this. Without naming the name, there is a big player in the space who has a private credit fund, and I think it's really interesting because there's companies out there that are going to need financing and also understand that there are people that understand their business model and understand that they have assets on balance sheet that are worth something. And so if you look at it in a similar fashion, you're just underwriting to a different set of collateral. And if you can get comfortable with that collateral, whether it's property, real estate, and digital assets, it's really just an LTV game. Like if we can want to lend on a 50, 60% LTV game, and I know my collateral, and I can get comfortable underwriting that collateral, that business model makes a lot of sense. It doesn't matter what the collateral is. And I think we're going to see a lot of interesting collateral as we continue to move forward here.
We have time for one more question, so make it a good one. Yes, sir, in the back.
How many investments have each of you guys made in the last 3 months?
How many investments?
Yeah, and how many do you expect to make in next? Either the underlying fund or equity in this space.
I think he said, how many investments have you made in the last 3 months?
So we track 525 crypto hedge and venture funds. We've diligenced about 85. We've invested in 4 funds. We're very patient, very diligent. We like to watch and track any manager that we invest in. So that's from our standpoint.
Yeah, so we're not live yet, so we technically haven't made any investments in our fund of funds vehicle, but we have, in terms of direct investments, up to 3 funds that we've made investments in.
So we're raising our first funds. We're not deploying capital yet, so that's an easy answer. In my prior firm, we committed to a fund from Blockchain Capital. To your other question around how many investments do you expect to make, we'll make 10 commitments from our fund, and then we'll also allocate 10% of the fund towards doing direct investing in addition to the funds of funds portion of it.
All right, thank you all so much.